Hello and good morning, listeners. It seems that USDINR as a currency pair has gotten cold, like the weather across, having such sharp moves in both directions, giving more uncertainty and things to thrive on for the traders, but making it difficult for risk management. Welcome back, folks, to Almus Market Mornings with Shikhar Garg. And if we have to talk about updates, we see oil remaining steady after a lot of ups and downs, while the USD continues to lose strength or continued to lose strength yesterday. So, with a lesser momentum and eventual reversal. So, JK, I'd like to know, there's been a lot of discussions on the central bank actions with ECB staying put on another 50 basis point hike, while a lot of decreased action or less paced action by the Fed is expected. So, what are your thoughts?
Good morning. Let's talk about our own central bank. So every now and then we are reminded that rupee is not a free currency, and we are shown who is in charge. In fact, the tendency towards euphoria is met with a big hand of central bank yesterday, who turned it on its head. It was a typical example of the central bank's heavy-handedness on this. As we began the day, almost everything looked favoring rupee, rising further. DXY was lower. There were ongoing flows, and the rate had broken important technical support at 81.1020. But it was a situation when almost everyone thought alike and was positioned alike. A perfect setting for RBI to step in and squeeze out the excess. Once back above 8120, obviously stop losses took care of further moves higher, ending the spot well above previous day's close, and got the market talking about fresh weakening phase for the rupee. Objectively speaking, it is clear that authorities do not want too much appreciation in the rupee. Possibly the right policy, as we are staring at sustained trade deficit, underperforming exports, and need to attract flows. However, it will be a balancing act to ensure that it doesn't weaken too much as well, because that adds to imported inflation and, more importantly, deflate the confidence in the currency. So an equilibrium range of 80 half to 82 half may be established till the external macros for us change drastically. The dollar index itself seems to be on a sustained falling trend even after reaching an important support level, and there is no visible turn seen and not even minor corrections are being sustained. It's been a combination of bad economic data from US, leading market to get confident of an early end to rate hikes, better picture from other economies, and more than all, a super hawkish ECB whose members are losing no opportunity to hint at further hefty rise in rates. We had another speech from Lagarde yesterday who said interest rates will have to rise significantly at a steady pace to reach levels that are sufficiently restrictive and stay at those levels for as long as necessary. In other words, we will stay the course to ensure the timely return of inflation to target. So ECB's inflation target is 2%, but the latest inflation number was 9.2%, and a huge gap to fill, even assuming that the base effect advantage can creep in the coming months. So that's another central bank for you. And we had the other central bank of BOJ, who has been very active to ensure that the yield curve control does not go out of control. Yen stood out with relative weakness. Investors continuing to buy back the excess dollars they sold before the BOJ meeting of last week. But of interest, or you can say significance, is the BOJ gained some control of the yield curve control through its extraordinary loan operation, which saw demand of just over 3 trillion yen for the 1 trillion of yen 5 years loan on offer. The loans are effectively an offer by the commercial banks to borrow cheap money to buy JGBs. But there is a mountain of resistance at 132 for yen, which will need some large positive trigger from US as well. The commodity currencies are on a roll with the China rebound optimism goading the prices steadily higher. Yields were inching up again across markets, not just due to hawkish ECB, but also the upward move in oil prices, which is getting anchored. And even as the recent crude oil price cap has already been put in place by G7, another headwind is emerging as they are contemplating tightening the noose further on Russia's energy revenue. Beginning February 5th, G7 will impose price caps on Russian products such as diesel, kerosene, and fuel oil in a bid to further cut Moscow's revenue from energy exports and its ability to finance the war. It's inconceivable that with economy getting increasingly hurt, Russia would not be resorting or rather retorting to these moves in some way or the other, giving rise to fresh vector of geopolitical tensions. Uh, Today, we have several business surveys in the US, like Philly Fed Manufacturing, and also the Richmond Church Fed Manufacturing and Services surveys, which will actually set the tone for hard data which is ahead. And after last month's ISM showing services sector dropping into contraction territory, we'll be keen to see how severe the dip in the activity is. Wall Street, just to recap on equities, yesterday investors bought back some of the beaten down stocks, mainly on the tech sector, which reflected gains for Nasdaq of 2.01%. And it has made a good start to the year by gaining more than 11%. This is happening ahead of some of the high-profile earning reports, which shows it is a short covering action, and market has discounted bad numbers to some extent. The global composite of equity indices has well moved higher by 1%, taking cues from US market. So all in all, weakening dollar scenario, China rebound optimism, and US probably getting closer to cap, or rather the highs of its interest rate cycle, keeping the risk sentiment somewhat positive, but investors definitely remain very, I can say, very cautious about getting too carried away, because inflation can raise its head again as G7 contemplates more action against Russia. And many people are seeing that while we may have a big dip in the inflation in the next 2 to 3 months, the second round effect of inflation is very likely to show up in the, later in the year. Thank you.
Okay, interesting, JK. I mean, a second round of inflation is something different to hear about. And folks, even though we have been seeing central banks acting a lot towards managing inflation, and now are heading with another concern of growth and recession on the brinks with expected rate cuts, another round of inflation is something different and a new animal to talk about in the coming days. On the other hand, G7, as JK mentioned, are contemplating further actions against Russia, and the geopolitics does not seem to have any sort of end in near term. But on the macro side, we see BOJ struggling to maintain the yield curve control as they've been talking about, which constantly puts Japanese central bank also as one of the focal point of actions in the financial markets. Although we have seen the commodity currencies taking the center stage for time being, as you can also see it for Aussie dollar enjoying the gains. Other than that, on the domestic front, folks, as we have seen, the big brother does have significant authority over our currency in retrospect or in any other manner, if we have to talk about as against the free currency that we generally talk about. Let's see how the big brother continues to act in the markets. Till then, we say goodbye and thank you so much for listening. We'll come back again tomorrow with another round of updates.